Good afternoon, Stock Trader Network. Good afternoon, Pre-Market Prep YouTube channel. We are here for a very special day, the pilot episode of CC Lagator's Options Unchained. We're going to be doing this show at 1:30 p.m., 1:30 to 2 p.m. Eastern Time every Wednesday. CC is also going to be on Fridays on the Stock Trader Network, but this is our new thing, a little free content here by the Stock Trader Network on the Pre-Market Prep YouTube channel. CC, how you feeling on the first episode of Options Unchained?
This is going to be fun.
This is going to be fun. And we got a little intro here. Why don't we run the intro and then we'll be back and we'll get into a little bit of like what's going on with the show, why we're doing this. Let's check out that intro.
All right.
How cool is that?
Rock and roll.
Josh did a good job making that intro, and like you even got a little logo here, CC. It's like three little chains, and the one's a little broken. It's Unchained.
I didn't even check if we were breaking any copyright there, so hopefully nobody else has used that before. It's
probably be fine. We'll probably be fine.
Nobody's watching.
We'll ask for forgiveness. We'll shoot first, ask questions later. So CC, give us a little preview here. Like, what was some of the impetus for wanting to do this show? Like, you know, what's your big angle here for Options Unchained?
Yeah, so I've been appearing on the Pre-Market Prep show for years now, and you know, we generally schedule it on options expiration mornings. Sort of go over it. It's sort of turned into an appearance where I'm kind of describing the effect that the options market has on the equity market, right? Most people tuning in are mainly trading equities. They might be dabbling a little bit into options. So we tried to keep it as non-nerdy as possible on the options front. Although, I can see the comments and I'm talking for a little bit and I can see everybody being like, oh, he lost me there, right? So what we decided to do, and also I'm appearing every Friday on the Stock Traders Network at the same time on Friday, where we're getting a little bit deeper into the trading. We're going over like potential trade ideas and everything. So we got together as a group and decided, let's put it all together for an options branded show where we do a little bit of everything. We'll do, and we'll do it on this pilot show where we're talking about the effect that the options are having on the equity market right now, which is super interesting today and over the past week. Then we'll talk a little bit about, today there's a bunch of earnings we can go over. We'll talk about, how the options market, the lens of which, is seeing those potential moves, potential trade strategies and everything. And then I want to do an educational segment every week. And this is sort of, so we may, in this case, we may talk and use some terms for the first 2/3 of the show. But every week I want to be adding to that library, sort of evergreen content where we're sort of saying, this is, the terms we're using, this is what the best things to understand. And I want to do it in a way that is as plain English as possible, as you can, what I always say about options, and I was an options market maker for years, and I've been a trader and in the space and building product for a long time since then. If you can understand in-game futures on your DraftKings, if you can understand the odds of a horse race, if you can understand those types of things, options should not be scary at all. The math is not that complicated. There's a bunch of variables that go in. There's some that are way more important than others, and we'll get into that. So today we're going to start simple with calls, puts, buying, selling, the premium collected versus unlimited potential gains. We're going to start simple, and then each week we'll add a little bit more to that library.
Love it. Love it. That's awesome. I think this is going to work really well. And personally, I've never traded options before. I have to come in contact with them all the time, working in the markets, doing news, doing research. But I'm going to be one of your people getting education here, CC. So I appreciate this. I know the chat appreciates this in the STN room. Looks like we got a few in the pre-market prep YouTube channel already. I think this is going to be the start of something great here.
Yes. Well, let's get into it.
Cool.
So the first thing I want to talk about, and this is something that, kind of will resemble my appearances on pre-market prep, is that the options market does not drive the stock market and the equity market. Sentiment, fundamentals, everything is doing that heavy lifting of the general trends. But the options market really has a sometimes outsized effect on how the market is trading. And that's sort of the most important thing to know. And that's what we're going to kind of start with, is this term gamma. And it's become really popular in the last couple of years. You'll see it on social media. You'll see it in, stock trading chat rooms and everything. And I kind of wanted to go over that and what's happening in the market right now. So
Cool.
typically, what you would see in a market is as you climb, as the market goes higher, you are seeing the VIX come down, and you generally start to see the market become a slow, predictable grind without many down days, without many air pockets below on a scary day. And that's generally when you see, you can go and look at the VIX and it'll be 14, it'll be 15. And you have this very predictable market that generally means the SPX is probably only going to move. It's going to move less than 0.5% a day, sometimes only 0.25% or 0.33% a day. That's sort of your typical market backdrop. And what's happening in the options market, the way that's becoming a self-fulfilling thing, is as the market goes higher, the market is running into calls that have been sold across the entire options market. And the easiest way to think about that is the general options positioning of hedge funds, of ETFs, of banks, even of retail for the most part, is they own equities. They sell upside calls against their equities, hoping to take in income. And then they buy puts to the downside to protect those gains. And you may even own some ETFs in your portfolios that do these sorts of strategies. And they're just basically collaring the market as it goes higher. And oftentimes you'll see the market run into these sort of walls of these upside calls, consolidate for a little while, and then finally sort of absorb all that overhead supply from the stock market, and then is able to go up another 0.5% or 1%. And it sort of looks like a staircase up. When you have a shock or a sentiment change or something like that, which we just saw, last Friday, going back to the, ramping up the China-US trade war again, that sudden shock, we were in that condition I was just describing, where there was complacency in the market, but that complacency was well placed because the chances of a big crash from that environment were very slim. What that Friday did, that Friday big 3% reversal in the market, is it didn't necessarily get us down to those put levels that I'm describing. But what it did is suddenly everyone raced for protection. Suddenly everyone went out and bought options. And that condition that I just described reversed, where all of a sudden, and I'm going to go back to the word gamma, you go from a normal long gamma, the market is long gamma, meaning it's helping it stay in place, to the opposite, where it's accelerating moves intraday, it's accelerating gaps overnight. And it was exacerbated last week because we had a monthly options expiration. So all of a sudden, that short gamma in the market is actually acting the opposite way, where, even today, we had a story about an hour ago, which I believe was the reason the market just tanked a little bit intraday, and then kind of spiked back, but now we're retesting that low. And I think it was an article in the Wall Street Journal about the Fed flying more blind than we even thought, meaning that they have even less data in their hands going into next week's meeting than we even thought. And that's the kind of thing that in this environment, now all of a sudden we're looking at a VIX back over 20, and we're looking at these kinds of intraday moves where all of a sudden there's a chance that the market could just move 1% intraday on a dime, like we're seeing right now. And that's basically what's going on in the market right now, why it feels so shaky, even though we are just barely below all-time highs. We have this sudden option backdrop that is a hair trigger for any kind of move up or down. And right now we're seeing it kind of get tested to the downside.
Gotcha. So CC, were you referring to, we saw a headline earlier about like the jobs data? Was that the
I
thing that you
think
were
that's
talking
what it
about?
was. That's what it looks like on the
Interesting.
chart. I'm pretty sure that's what caused that.
Gotcha.
Um,
That's interesting. Yeah.
Yes. And so there's a question in the chat. My understanding of gamma is the acceleration of prices because it's a derivative of delta. That's sort of what I'm talking about, is that when the market is overloaded with long gamma, when you're in a spot in the market where everyone's sold a bunch of options and sold calls, it actually, as the market goes higher, there's stock to sell. As it comes lower, there's stock to buy for people to remain delta neutral. When it's the opposite, and market makers at Citadel and Jane Street and all have sold a bunch of options in the area that the market is in right now, they have to chase moves higher and they have to chase moves lower in order to stay delta neutral. So hopefully that answers that question.
Yeah, I think that makes sense. And CC, I see you have your options AI in the background. Let me know when you want to take a look at that. And I also have the image that you shared with me a little bit earlier, the expected move. So just let me know. I'm in the background. I'm going to move to the background. Just let me know whenever you need a hand, okay?
Yeah, so let's go into the next part, which is, okay, so now you have a VIX at 20. And Brent, why don't you throw up the slide that we have for the expected moves over the next day and week? Cool. And what I want to use this as is kind of a general sense. Everyone can kind of look at the VIX and see, the VIX is high, the VIX is low. It's like, what does that mean to me practically? And so I made this last night. So it's based on today's opening prices, that 1 week range over to the right side. But basically, this is what the options market is pricing day to day. And this is all going to be a little bit higher, especially if we close down on these lows this morning. So basically, for SPX and SPY, where the options market is pricing about a 0.5% move a day. And then going out over a week, it's pricing about a 1.5% move. As you can see, IWM, which is usually more volatile, but sometimes those diverge where you're seeing particular volatility in small caps. IWM is probably getting closer today to a 1% move a day that's being priced by the options market. And over the next week, it's probably getting closer to 3%, which is pretty staggering. And that's only with a VIX at 20. So you can imagine what these numbers look like when you have a VIX, a spike up above 30, is sometimes they'll be our most volatile weeks going back to April. You would see an SPX expected move that week of like 3.5%. Which is kind of a good way to think about it. It's like, how do I translate the VIX? How do I translate the IV that I'm seeing on my options chain? A really good way to translate those numbers is into what that's pricing as a potential move. Now, that doesn't mean that the market is going to move exactly that amount. What it's basically working as is almost like a point spread of a football game. And it's basically saying the market, all of the options trades combined, and all of the market makers and everybody on Robinhood and everybody at Goldman Sachs has reached an equilibrium number where this is the expectation. And if the market moves more than that, that means everybody was wrong and options were underpriced, as if it was betting the under on an over-under. And if the market stays and kind of goes flat within that range, then everything options were overpriced and everybody was too panicked. And then Brent, do you want to go to the Go to the Options AI SPX chart.
Okay.
And I'll go over a little bit here what we're talking about. So as you can see here, so this is from the Options AI platform, and it's an expected move chart out into the future. We're just looking at a 5-day chart in the SPX, and each day you can hover and you can see this is current, real time, what from the options chain, what options are pricing out for the next few days. And as you can see, if you go to the 1 month chart, you can also see the IB here. So for tomorrow, it's about 18 vol. For Friday, it's almost 20 vol. So that's up a lot today. And then as you can see, as you get into next week, you can see the Fed meeting right here where we get another spike in vol. And you can take this up against the chart and kind of figure out, all right, so into month end, the options market, that's when it's pricing the prior highs. And we look at this low from back in the latest tariff tantrum. The options market is pricing the potential of that happening also by Halloween. And you get a good sense of like the time that the market is currently pricing for these moves to happen. All right. So the next thing I wanted to go over is obviously we have a big earnings week, and you've probably heard me use this term on pre-market prep when we talk about, and Dennis talks about expected moves a lot. So the expected moves, and let's just go over, the Texan, which reported last night, which is an interesting one. So the expected move in Texas Instruments last night was about 6 to 7%. And we're down about 8% today. And it was even lower earlier. It was, practically 10%, let's say, at its lows on the open. And it immediately found buyers. And what the options market is doing is it's saying this is the amount of risk going into earnings in either direction. Again, talking about that equilibrium of the options market. And you can see it if we go into Tesla, which is reporting after the close today. We're going to go in here and we're going to see that the options market is pricing just shy of a 7% move. And what is often the case in a situation like this is that expected move is often lining up roughly with some technicals in the past. The options market is leaning on technicals just like everybody else is. And in this case, the options market is basically pricing about 400 on the downside in Tesla. And it's pricing about, call it a little bit above 460, somewhere between 460 and 465 to the upside. Now, what's interesting about that is 400 is a big round number, but it's also an intraday low from that reversal we saw last Friday in the market. And then, of course, 465 is pretty close to these recent highs that we saw at the beginning of October. And so this is essentially the options market saying that Tesla is expected to stay within this October range. And so, of course, if there's a situation like Netflix, which was pricing a 6% expected move last night, and you all of a sudden get a 10% expected move, that means the options market was caught fairly significantly off guard. And that's a bad move in Netflix, because that means it did not find buyers where the options market thought it would find buyers after hours or even today. And it still hasn't to this point. So when I'm looking at, and now we'll get into like a little bit of like trading thinking. When I'm looking at options, this is pumped volatility. These are pumped options for this earnings event in Tesla. And I'm looking at it right now. It says 116 vol tonight, which is extremely high. And you can see, where that would compare to normally by going farther out here. It's about twice of what options are trading, out a month as far as the price and the implied volatility. And so you have to be very careful when you are positioning for a move through earnings, you should be looking at this as your potential risk or reward if you're long Tesla stock or short Tesla stock. And if you're involved in options, it is basically telling you that if you are long calls, you pretty much need Tesla to go up back above 460 on earnings, or else that volatility crush that happens after earnings in all options are going to come in a little bit, and you're going to be at risk of even getting the direction right and potentially losing money. So what I like to do in situations like this is I'm looking at, one of the first things I'm looking at is potentially selling a move by selling options on either end of the move, seeing what the risk reward is of collecting premium if it doesn't go up above 460, and if it doesn't go below 400 on earnings. That's the first thing I look at. Netflix yesterday, I was kind of tempted to do a bearish trade just looking at the chart. Kind of wish I did, but I didn't. And we can get into this kind of more nerdy content in a bit, which is iron condors, even credit put spreads, credit call spreads. But for now, I want to kind of keep it simple. And we're talking about expected moves, volatility, gamma, how the options market is affecting stocks and affecting the overall market. So I'm seeing TJ Mosley. Dennis calculates the expected move, adds the at the money call and at the money put, and gets a number. That's exactly what you should be doing. And the reason for that is, if you think about a stock trading 100 and you're looking at the 100 strike, if the call is $2 and the put is $2, all $4 of that is fluff. It's an extrinsic premium is the term used in the options market. If the stock was 102 and the 100 strike, 100 call was trading $3, $2 of that is real. It's intrinsic value, right? It's $2 in the money. And then that extra dollar is the extrinsic premium, is the fluff. And the fluff is what all those Greeks go into figuring out. And that is constantly expanding and contracting as volatility comes in and out. And then it's decaying over time as it gets closer to expiration. It's very similar to the way an in-game betting futures that can be worth zero, like let's say you bet on the Giants Broncos game last week. I'm sure the Giants were trading at 90 right before the game, like in those final few minutes of the game, and then they went to zero immediately. And so that's sort of how options work as well, is but earlier in the game, even when they had a 18-point lead, they might have been trading closer to 65 or 70. And that's the exact same way the options premium sort of expands and contracts. And then as you get closer to expiration or closer to the end of a sporting event, it starts to go either to 0 or 100 very quickly. And that's the best way to explain that. And so the at the money straddle, the reason that's used for expected move is that's the price of all of that extrinsic premium. You're adding the call, you're adding the put, you're doing it at the money to get rid of the intrinsic value so that you can see the extrinsic value. It's all the fluff in the options market.
CC, I'm popping in with you here because you're throwing a lot of knowledge at us here. And this is a very special day because we have not had a 1.1% sell-off in the S&P. Well, actually, just since about a week and a half ago when the Trump tweet happened. But there's definitely some carnage happening here today, like in the tech realm. If we look at the SPY, it's down 1.15%. Qs are down 1.84% here now. Across the board, it's pretty heavy. You were talking last week about how protection was cheap. You were on the show talking about maybe you should jump in and protect yourself. I know, now it's a little bit tough. You come in and hedge at this point in time. you're hedging at very low prices when the VIX is elevated up. But I think we can all learn, from, maybe you can just talk to us about, how you would approach the hedge last week, into a market like this,
Yes.
so can you talk about that, just hedging for a little bit?
Yeah. So now with the VIX, we've been talking about, going back a month ago, we started talking on the shows about the potential for hedges into year end and that volatility was really low. And what I was saying at the time was, it's one of the few times where I would say just go out and buy, puts. Like if you want to hedge your portfolio, you want to protect gains. Typically, I would say do multi-leg trades. In an environment like that, I didn't see any scenario where vol went down. And you and I talked about it a little bit. We were at a moment at the highs in the market where even if we broke out, it was probably going to be some AI mania. IWM was about to break out. Volatility tends to go up in those kinds of manias, in those meme stock moments. And then obviously what we're seeing now, when we start to go, and there's a little bit of fear in the market, and we start to go lower, volatility pops. So in those scenarios, when the VIX is 14 and you don't think that there are many scenarios where it can go lower, and you look out a couple of months, just buy puts, go down about 5-10%, wherever you feel like you would hit your panic mode and you would be selling stocks, and you don't want to be that person. Sort of position for that kind of move. Now, I would say with the VIX back over 20, I think you kind of got to spread these trades, right? Because what's going to happen is you could be right. And let's just go in and like kind of price out a few things. That's the trade we talked about last week. So, if you go out to, even December, let's go out to like December 19th, right? So the expected move out into year end right now in the Qs is about 7%, right? And that's at 22 vol. So that's, it's spiking a little bit the last week. So if you're looking at this chart and you're looking at this 1 year chart, you're like, all right, where's my pain point? Let's say is I'm long NVIDIA, I'm long Microsoft, we're all long all of these things. Even if you don't know it, you're long these things, because if you own indices, if you own ETFs, this is where the real risk lies in this market is, all of that AI trade starts to kind of, not unwind, but it starts to test nerves a little bit. So in that case, I'm looking at, and, Dennis, I don't know what your level would be, but, 540 in the Qs down 10% from here would be pretty, that would be pretty scary.
It'd be pretty, yeah, for sure.
Yeah. So,
it'd get people a little bit nervous.
Yeah. And that's the level that that was before the April tariff tantrum, is about 540 in the Qs. Zooming in a little bit, like if you're looking at more recent action, you can make an argument maybe like 560 or something in the Qs you might want to protect against, or even, you could say even 570 or something. So that's the way I'm looking at these kinds of levels is, what am I willing to pay to be able to sleep at night? So looking at this, like we can look at an at the money put, right? So with volatility now pumped over the last couple of days, and it's, 20 VIX is not that high, just, historically.
It feels high today, but you're right. Like we could get way worse. It could get way uglier.
Yeah, it is definitely not the moment that you step in and you buy stocks because the VIX is 20. Like this one feels like it needs to get to 30 before you hit that moment, right? So in this case, we're looking, just in an at the money 600 put. Right now, it's almost $18, which means your protection doesn't really kick in until this thing gets down closer to 582, which, as an outright bearish bet, if we tanked from here, that could work out fine. But that's way too much money for me to be protecting my portfolio, because if we just bounce and go higher, I'm going to be really pissed that I, basically just, cost myself 2.5% of my portfolio on a trade like that. So what I think you have to do when the VIX is 20 and higher, you have to be looking at put spreads. And as you can see, this is a 600 560 put. So this is getting us down to, one of those areas we mentioned, the 560 level, where it's like, all right, I don't want to be a panic seller of my longs down there in my portfolio. So what this is doing is this just reduced the price of this hedge from 18 to under 10. So now all of a sudden we're looking at a break even of 590 instead of 582. I mean, 590, we're down 10 points today, right?
Yeah.
So that could happen, by Friday, theoretically, if this thing got ugly. So now we're getting into kind of a realistic mode where I'm like, all right, that's pretty interesting. And then you can play around with like those strikes. You can like kind of move this lower, and I'll zoom in here so we can see it. You can move these strikes a little bit lower. Maybe you're like, I only want it to start at 590 down to 550, zooming out on the chart. Now we've got back to the 582 break even, but now we're only paying $8 for this thing. And so that spreading options trades in a high vol market, to me, is extremely important, because the difference, and just sort of to wrap a bow on that, you might say, well, why don't you just go farther down and buy a put farther down? The problem with something like that is it's not really protecting you. Like if you bought the 560 put here, you might get a move down to 575 in the Qs, and your put's done nothing. You've taken losses in your stock. Time has passed, you're a month in. So you have to be very careful about just sort of buying out of the money options, particularly once vol has spiked a little bit like we have right now.
What about from, a speculative perspective here? And there's a lot of people, like I just got a message here right now, looking to buy the dip. They're coming in and they're like, oh, I've been waiting for a dip on AMD. I've been waiting for a dip on NVIDIA. I've been waiting for a dip on Oklo. It feels like it's not just a dip. It feels like a pretty good, how do you approach, like, is there a better way to maybe a safer way? Because you're just trying to call a shot. Oklo, the thing just dropped, $40 in 2 days. You're just like, I go buy 114, it'd be $100 on me tomorrow. Is there a better way to use options maybe to speculate on a bounce here?
Yeah, and this is interesting. I was watching pre-market prep this morning. You guys were talking about like IONQ as well.
Yeah.
These things.
Wild.
You talk about like, just look at this 5-day chart of these sorts of stocks. And, what are we down from the highs in the market? We're nothing, right? In the SPX
2%.
like, nothing. But man, look at these stocks. So, and I don't even know if this is, but this is that momentum trade that was happening right here. And that took IWM, it helped take IWM up to those highs and make new highs. It seems like it's all getting unwound in the last week. So turning that back around, let's just go back to Oklo. This is really fascinating because what happens in a normal market, everything we started the show about, which is the market goes higher, vol goes lower, the market, sells off, vol goes higher. That is true for the SPY, the Qs, even IWM. It's true for, it's true for NVIDIA too, for the most part, or Microsoft. It is not true for these stocks. And so what happens in a situation like this is when Oklo was making this move, and then when Oklo was making this move, volatility, the price of options, was exploding. And the reason for that is because a stock that used to have a move from 65 to 85 all of a sudden has the potential to move from 75 to 200. Yeah. So options just absolutely explode. You go to buy a call or a put that's $50 out of the money and it's cost $25. You're like, what? Like, I don't even know how to wrap my head around that. So to the question of if you were to buy the dip in something like this, Oklo vol, IONQ, all of these names like HUT, sure. They all have this same chart right now. Their volatility has actually collapsed as it's come in, because now all of a sudden it's like, man, is this thing ever going to see a high again like that? And you can see this on the chart. So Oklo's made this move from basically 195. When was that? That was October, the middle of this month. Last week, right? So last week to now, so this is kind of hilarious. Last week to now, it is, 7 days. The options market is pricing Oklo to go back to that high. Take a guess. I'm on the chart right now. Next summer, right?
Okay.
So that's how much wind has. So everybody that's sitting here being like, oh, this thing could snap right back to the high. It could, but the options market is totally thrown in the towel on that being possibility. So now all of a sudden you're looking and you're saying, all right, well, it could bounce. I mean, you look at this chart, right? And that bounce could be pretty significant. Where could it go? I don't know, 145 seems realistic to me. And in that case, what's that?
It was there yesterday.
Exactly.
But it's going to be tough to get back there.
Yeah. But that's where you start to look and you start to say, all right, well, the options, let's just go. You got to give yourself time here, right? So let's go out to November. Let's go out to like Thanksgiving, right? And let's look at some, kind of like call spreads, right? So this is the 115, 150 call. And let's do 145. Isn't that what I just said? 115, 145 call. This has a break even low, below 125. You're buying the 115 call for $18, but you're selling the 145 call at almost $9 to finance that 115 call. Yeah. So to answer the question, this is the type of trade I would be looking at. I would probably give myself at least till Thanksgiving, if not closer to Christmas and all. And I would be looking to sell up. I think a bunch of these probably look like that kind of head and shoulders. I would be looking to sell calls up at that shoulder. Let's go look at the IONQ real quick. So let's see if this chart looks the same. Yeah, pretty much. I mean, this one's a little bit more ridiculous, but yeah, you 60, that 65 to 70 level, somewhere in there. You'd be wanting to sell an option up there because the chances of this thing going back to 85, like I'm telling you, the options market's saying like next August, like it's
like
totally
a year from now.
In the towel.
This is the tough side of the stock market. In 5 days, you can go down there, but it'll take you a year to get back there because the fun of math. When a stock falls 50%, it's got to go up 100% to get back to where it was. So it's tougher go.
This is one of those crazy stories where it was sort of like last week. You know how the market was moving like 2%, 2.5% a day intraday, and it was hitting the highs and lows like multiple times. And then the market would be like unchanged on the day. So all the headlines were like the market, unchanged. And like, if you were a trader, you were like, no, it wasn't. It was crazy. And this is sort of the same sort of thing, is that nobody's noticed, there's no headlines that the market's 2% off its highs on the Today Show tomorrow morning. But you might have been in a stock like this that is now down 70% in the last week, right? It's kind of crazy. Yeah. So all that it's really fascinating stuff under the surface.
Mm-hmm. CC, I know you wanted to get to like a little bit of just real basic education to get us kicked off with a little conclusion for the show where you're doing a little bit of education. But I had a good Ted Eaton had a good question here from you for you in the SCN chat. He said, I trade the daily QQQ weekly lotto options at extreme sell-offs like now. If you have a QQQ target like 605 when the Qs are currently at 600, should I buy the 600s or the 605s?
Did he use the term lotto?
He used the term lotto options, weekly lotto options. Yes.
Okay. So it's funny that has that become a positive term, or was he using that tongue in cheek? So what I would say here is the vol's too high. So if you're buying the 605s, I think even even this week, so I'm just going to go out to Friday real quick. Well, it's a tough one. So if you bought a call right now and the stock and the market bounced and you ripped back to 605, it doesn't matter what IV you paid, right? You were right. You timed it perfectly.
Sure.
I would be very nervous to do that with after implied vol just spiked like we just saw. So
Sure.
I would still spread this. I don't know if I'd do 600, 605. Let's just look at it real quick. So this is I think I'd go a little, higher. So let's look at 602, 607, right? So a 5 wide, this thing's costing you 240. I don't love it. Let's go back to just a call and let's kind of move this thing around. 602 is costing you 605 is costing you $3. You need this thing back at 608. Here's one thing you could do if you were, all right, this is a little bit more sophisticated than what we were talking about, but I would do this. So I would actually think about maybe selling a put spread in a situation like this. And the reason I would say a put spread is you want to define your risk. You want to make sure that if you're wrong, it doesn't cost you an arm and a leg. But in a situation like this, you could theoretically risk 7 to make 3 on the Qs not finishing the week below 599. That's something to consider. That's a good segue into basically what I was about to talk about on the educational front. So
cool.
Basically, let's start with calls and puts. Everyone in the chat probably will understand, buying a call, you want the stock to go higher. Buying a put, you want the stock to go lower. But it's very important, if you're only buying options, over time, you're going to have a rough go of it. And that is generally because it's for a number of reasons, but there's nothing wrong with buying options. But over time, that is not a good strategy. You need to have a mix of selling options and buying options. So what I wanted to talk about is the difference between calls and puts. And that's a good segue, is you can sell puts to be bullish. You can sell calls to be bearish or add income to underlying holdings. But let's talk about selling puts. So the difference between buying a call, we were just pricing out what if you bought the 600 call, what if you bought the 605 call, is if the Qs bounced and they ripped and they went to 610 and then they went to 615 before they expired, you have unlimited profit potential. But you can also be bullish by selling a put or selling a put spread where you're collecting the premium, and all you need is for the Qs not to go down below the puts you have sold. And then you collect that premium. Now, the difference is that's the most you can make on that trade. So in this case, we're looking at a put spread where you're selling the 599 put and buying the 598 put. And we could make this, let's go a little bit wider. This is a $5 put spread where we're selling the 599 Q put expiring on Friday. We're buying the 594 put, which is going to cost us money, and it kind of sucks having to buy that. But this is to protect in case the Qs, in case the Qs drop, 5-6% into Friday. And in this case, we're risking, let's call it 350 to make 150. And it's a very high probability trade. It's, right now this is, that's basically going to be like a 65% probability that you are going to make money on this trade and that the Qs finish above your short strike. So I just kind of wanted to get, for the first week, the difference between buying options, which is sort of unlimited upside when you buy a call, or put, you buy a put, unlimited upside if the stock goes lower, versus the potential to earn money if something doesn't happen by selling a put or selling a put spread or selling a call or selling a call spread. And we'll get more into how you kind of piece that all together to kind of have multiple strategies. You should never just be long calls, long puts. You should have a mix in your portfolio if you're actively trading options of selling call spreads, selling put spreads. We'll get into iron condors. We'll get into all of that as we go.
This is going to be awesome. And just to say the obvious thing here, the platform that CC has been using is Options AI. He is one of the co-founders of Options AI. We do have a little code running. If you want to check out Options AI, STN Options AI, you can use that code. We have had a few people in the chat, more than a few people, I think, that have tried out the platform and have had really good response for it. I think this is going to be a good little midday piece of education, some trading ideas, and CC, you're just like a pleasure to listen to. Seems like you're a personable guy. I think we're going to have a lot of fun here building this with STN.
Excellent. And as we all eventually get replaced by AI, a lot of the things I'm talking about, you can just hit the Copilot button and it'll describe your position and describe your trade. And so eventually we'll just have the Copilot run the show.
Nice. That's what you just clicked over there, the little AI button in the corner.
Exactly. And so you can come in here and you can say, set up price alerts, automate my exit, manage my orders, and it'll give you a rundown of what's going on in this trade. Yeah, so it's really cool. I just hit refresh because that was an old, so this will be looking at your position. It's looking at all these probabilities of max gain, break even, max loss. And it's basically saying, your Q long spread expires the December 31st, current value, expected move with 69 days left. It's telling you what the decay effect will be. And then it can kind of, you can talk to it and say, set me up some price alerts. Like, where do I want, my price alerts? Where do I want a stop loss? It can do all that for you.
Awesome. And Ted responded in the chat and he said, I thought the official name for same day options was Lottos.
What's funny is it's like there's zero DTE trades on each side. There's some people selling the move every day as a strategy. And then we've always called, lottos of out of the money calls lottos. And it's funny that people in zero DTE are doing the directional trade and just saying it's a lotto.
CC, well, thanks for kicking off with the pilot here today. I think this was an excellent session. You got some really good feedback in the chat. We'll be here every Wednesday, 1:30 p.m. Eastern time. And CC, you're going to be joining us in the STN room on Friday also this week.
Definitely.
All right. Awesome. Thanks again, CC.
See you guys.